I think this is a slightly hawkish statement. It's very good that they have changed the wording from the last three statements, so it's made it clear that they think 3 rate cuts may be enough for a mid-cycle adjustment. But as I said, I'd like to see them say they were going to be patient to take December off the table. They haven't quite done that, but they've gone about half the way. So it's a thin line on the sand.
Yeah, and then we're going to have the press conference in a few minutes. That'll be another opportunity for Powell to clarify that and maybe harden that statement a little bit. And then we're all going to go into Fed speech watching mode to see if other Fed members kind of reiterate that view that we're on hold for now.
What if he hardens the statement with the notion that a cut in December is off the table? How do the markets react?
Well, right now, December cut, while partially priced, it's a pretty small probability. So I don't think we're talking about taper tantrum sort of market reaction to that.
We're showing some of the Treasury yields here moving higher. John Bellows, for you, I mean, the inversion of the yield curve earlier was a big argument for the Fed cutting rates. What do you think rates are telling us now?
Well, a lot of that inversion's come out as the Fed has cut rates down to the forwards, and so in a sense they've provided the accommodation the market thought that they should. The interesting question is, where do we go from here? And so, modifying the word act is perhaps a tad hawkish, but I'd note that they still are monitoring developments, still focused on the risks. I don't think this is that big of a change. And I think the Fed going forward, is going to be focused on that big picture we were talking about earlier, slowing growth and below target inflation. Not only is that not an environment where you have to be hawkish, you're not hiking, but I think the risks continue to be to the downside in yields in that environment.
The stock market doesn't seem to be jolted by any of this, at least not right now. Wait until the press conference. But remember, Melissa, in the summer when you jumped appropriately on the idea when he said mid-cycle adjustment, not the beginning of a major rate
right.
Cutting cycle, a mid-cycle adjustment. Now we and the markets seem very comfortable with the idea, more than on that day, that what this is a mid-cycle adjustment. Have I got that wrong or right?
No, I think you've got that absolutely right. I mean, the economy, to your point earlier, David, we've slowed to 2%. So it's not that we've gone into sub-potential growth territory here. So for the Fed to pause here and then wait to see all this easing feed through and see how much it feeds through, I think that makes sense. We have to remember, in aggregate, just forget the Fed, all the global central bank easing we've had this year is the greatest we've seen since 08-09, which is kind of amazing. And we should give that a little bit of time to play through.
But also, remember that the problems that are inflicting the global economy, the U.S. economy, are not about high interest rates.
Right.
It's trade confusion, bad demographics in the United States. These are things that we can address, but the Federal Reserve cannot address.
I hear the spectral voice of Steve Liesman trying to get in. Steve.
I guess that's good to be spectral. I'm not 100% sure. I need to look that up, like the word transient we did one time. But I think there's a difference with this change here. And we'll see if this kind of, calm in the market remains as a result of this change. But the Fed made this change with the market very prepared for it. I don't think when they heard mid-cycle adjustment it was ready for that phrase. I think the Fed kind of has signaled pretty well that, we were going to do this mid-cycle adjustment, and he kind of stuck to it. And then this idea of a pause, it's really baked into the market. The Fed today, in this statement, in this change, maybe did it in a way the market didn't actually expect, but didn't really tell the market anything it wasn't anticipating. In a sense, the market has given the Fed the leave to do what it did today. We'll see if this remains through the press conference, but this is an expected change that was really fully priced in to the curve or the outlook or the term structure of the Fed funds rate.
Just looking at that as well, we have the sort of the shorter and the 2 years, the 5 years. I mean, those are popping more obviously after this than the 10-year guys. So in other words, the curve is flattening a little bit, which is, you could say, not the sign you want. The steeper curve is usually the better sign, and we had finally gotten to that place. Does this unwind that at all, and if so, in a meaningful way?
I don't think this is going to be a detriment to sentiment when it comes to investing, if that's what you mean. If people worrying about a flat curve, an inverted curve as a sign, the Fed affecting this, I don't think matters that much right now, because you have this sentiment shift coming from taking some of the tail risks off the table in terms of Brexit. We'll see what happens with trade. Obviously, it's not happening in Santiago anymore, but it feels like the worst case scenario has become a smaller probability. And when we look at some of the soft economic data, the sentiment data, it's gone from constantly deteriorating to now just kind of stumbling along a path. So without getting too wonky, the second derivative's improving. And so I think that better sentiment tilt is going to help kind of keep a balance in terms of what the Fed's doing today and signaling.